Hey, good morning, everybody. Thank you for joining me for this weekend edition of the podcast. And we're just going to just quickly go through kind of a snapshot of where we are. And of course, the S&P has had that breakout recently, and really last week there were some jitters, more economic news that came out. Really in the last 2 weeks, we've been seeing some stuff that was worse than expected. Whether it's confidence numbers or some of the employment numbers. Just a lot of things that were coming in a little bit worse. And so, again, the market's been getting kind of skittish back and forth. And as I've said, the first reaction generally when you get a bad jobs numbers for the stock market to sell off very quickly, only to come to find out that as the day progresses, investors realize once again that what does that mean? That means that the Federal Reserve will continue to be there purchasing their $85 billion a month for who knows how long. And that is supportive to stock prices. And that's exactly what's going on. I think, we saw that, I guess it was about a week ago when the jobs number came out on a Friday. I think it was this day, where opened down quite a bit and then kind of reversed. Still was down on the day, but not nearly as bad as first indicated. And then we ended up having a pretty good week overall. Had a little bit of a down day on Friday, but if you look around right now, it kind of feels like the stock market has had a 10% sell-off, and I think the reason why is because there are a lot of things doing that, and people are worried that it's going to fall. But again, you have to look in the big picture. What's happening is, Japan continues to depreciate their currency, and by the way, here's the Japan yen ETF. So if you wanted to either go long or short the yen, the Ridex Yen Trust is the way to do it, FXY. This is a picture, and if you were to look at this, you would say, well, this has to be some type of tech stock or something going from 130 down to 99. No, this is a currency. These are huge moves for a currency, but let's remember what Japan's doing. They are essentially following the Fed's model now, and they're upping their printing presses, and they're devaluing their currency on purpose, and it's helping their stock market temporarily. But what's happening, I think, is money is flowing out of the yen, and it's coming over to the U.S. dollar. So we've been seeing this big move in the U.S. dollar. Now, this move in the dollar obviously isn't as big a move as we've seen in the drop in the yen. But overall, I think you're seeing a global shift where people are selling the yen and they're using that to fund other assets. So they're selling the yen, and then when they get those proceeds, they are going out and buying, good old American U.S. stocks. Hence, the Dow Jones, still continuing to push up near 15,000. The Nasdaq's showing a little bit of life lately as well, and the S&P, of course, is near this high. So I think that's what's happening in the big global picture. Now, for you and I that aren't, shorting currencies in one area and going long in other areas of the world necessarily, we just need to say, how is it affecting us? But one way it's affecting us is, and probably a lot of you do own big chunks of gold, but that was the story on Friday. The gold bugs, the ones that have been saying gold is the place to be, the Peter Schiffs of the world, are getting crushed right now. And they can come on TV and say, well, it's a buying opportunity, and this is exactly what we wanted. It was this great long-term buying opportunity. That's all fine and dandy, but it's going down at a very, very fast rate. And a couple of weeks ago, we had talked about the fact that gold was at the support level. If you go back, let's go back really since we'll call it the end of 11 or beginning of 11, and then 12, and then in the middle of the summer of 12. And then here recently. So we said, don't count gold out just yet. It's still got one maybe a last breath left. And so it was supportive. So if you were, again, looking at this from a longer term, you would say, well, perhaps it's going to bottom around here and at least make an attempt to go back up, even if it's over time. And then maybe we could see it fall back down. Well, that's not what it did. It made this huge dump. I mean, it was down almost 5% on Friday. Just a big drop in gold where everybody saw this level, obviously, and we saw big volume. If you see the volume here on the right big jump in volume. The biggest volume going back all the way to probably 2 years ago. So big drop in gold. And again, that's why, gold, you can have a maybe a core piece because it is kind of this zero correlation over time asset, but you have to still keep things in moderation and also use some of these things and go more heavy at times when they're be opportunistic and lighten up on them at times where they're not working. And gold obviously isn't working right now, and it just completely vomited on itself on Friday. Now, if we look at a longer-term picture going back, this is the picture that I think is also important. And we're right in this support area. Now, some people may change their picture to logarithmic. Maybe they don't have a logarithmic. So some of these pictures can, you could say this doesn't look the same on my screen. But in general, we're at a point right now where certainly it's broken down. And obviously, some of these longer-term moving averages are crossing too. I mean, if you look at the 50-week has crossed the 200-week, those are things that haven't happened since 2009, and that was just a very brief moment in time. So again, what's happening right now is there's a shift out of gold, a shift out of yen, a shift into dollars and American assets. And so I don't know how long that will continue, but the bottom line is if you do have gold, hopefully it's a small part of what you're doing. If you're short gold, congrats, and probably it's getting close to the point where you want to cover that short at least for a rebound. And the most likely thing now, since it has broken down, is a rebound to the breakout level of, let's call it 150-ish on GLD. But that was the big news on Friday. Now, if we take a look at what's going on with the dollar, commodities continue to fall apart here. So we have a deflationary problem going on. That is why the Fed feels like they have the right to continue to print, because they're saying we're trying to fight deflation, so we're going to keep printing. And that's exactly what they're doing. But the dollar has been running up this year, and that has been why you've been seeing some of these things like corn going down and coffee prices and all those commodities, gold, those continue to fall. Now, the dollar has pulled back in recent days a little bit, but it's still up quite a bit. And in the meantime, the great rotation out of treasuries isn't happening. This is the 10-year treasury rates. So, there's supposed to be this money coming out of treasuries going into stocks. And while that was happening for a while, let's call it from last summer until here recently, this bad economic data, once again, is causing people to buy bonds. And let me flip it around and show you TLT, which is the treasuries, if you were to buy those treasuries. So you can see that, it had been falling, and we've had some life here in the last few days as there's been kind of a flight to safety once again. And so what we want to do is monitor not only how these are performing against stocks, but how they're performing against other types of bonds. We had seen high yield types of bonds outperforming, and then in the last few week or so, we've been seeing them underperform treasuries. So is there a shift going on back to quality? But again, it's not clear one way or the other. This isn't a trend, I don't think. Just like the stock market, while the stock market has been going up, it's getting you're seeing some underpinnings in the short term, a little sketchy. We're seeing some risk off days, some risk on days, but a few things that are still working, and we've talked about this in the areas that I'm still long. Utilities continue to work, and this is a very extended picture, no doubt about it, but it's working. And I think the reason it's working is for people who are selling gold or selling, the gold miners or selling material stocks, but they want to stay invested in equities because they see currency depreciation. They're staying in the safe trades such as utilities. I'm also long healthcare, continue to be long healthcare. And by the way, when I say I'm long something, I am not going to call you up and tell you when I'm selling it. So take that with a grain of salt. This isn't something for you to piggyback on and say, oh, Karl said he's long utilities, maybe I should go buy them. It's a place for you to start to research, to look at this and say, let me see why it's going up. Let me see if the thesis makes sense. But you have to understand that, obviously, as the disclaimers say, this is for entertainment purposes, and this isn't a recommendation for you to run out and buy healthcare and utilities. They are extended. They are going up right now, and they've kind of started to go parabolic. But what we want to see is what's going to overtake them in the lead? Is it going to be something like, is gold going to start taking over, or Treasury's going to start taking over? And we haven't seen that. What's working right now are still the safer trades when you look at the risk spectrum in equities. And again, what's happening is I think biotech is helping the healthcare sector, and utilities, those people still looking for yield. So all that continues to work. Now, speaking of oil, we were talking about commodities falling, and back in early March, I said that I thought this might be supportive simply because we had kind of a support right here. So if you connected the dots, this would be the area, kind of around 89 that it would bounce. And it did do that. It went all the way up to, 97 or so. And now you're seeing oil back down to $91.29. And again, it is at a critical spot where it should bounce. And you did see a close above this trend line, but let's see. I mean, we've got this kind of wedge forming here. And typically, the longer these wedges go out, they generally break to the downside, not the upside. Usually, if you're going to get a breakout, it would have come earlier somewhere, in here or here. And we're not getting that. We're getting to the end here. So we could see oil fall out of bed, especially if the dollar continues to rise and if we keep getting, economic news that is worse than expected. And look, here's what's going on in the economic situation still remains murky, even when we were getting those better than expected economic reports. I was telling you at the time, this isn't a runaway, reaccelerated economy. This was an economy that was proving itself that it maybe wasn't in a recession. And so you were getting these reports that were just a little bit better than expected. They were enough to surprise people upside to say, hey, things aren't as bad as we thought, and so we're free to go buy stocks. That was the mindset a few weeks ago. And that's why you continue to see stocks go up. And when you look at the S&P and things like that, it's not that the news is great. It's that it was better than bad. And, especially when you looked at things like the housing market, which is still doing very well. When you looked at the jobs, the quality of jobs, not good. Those leaving the workforce, all of that. But it kept beating the number. And, again, we could do a whole series of podcasts on where do they get the numbers, how are they calculated, conspiracy theory stuff. But bottom line is it was better than what people thought. And so the market continued to go up. Now you're getting in the last couple of weeks some numbers that are worse than people thought. And so you've seen the market kind of stumble a little bit. But, again, we're up near highs. And what we have to do is look at what investors are doing with their money, not what the Fed's saying, not necessarily what gold's doing. We have to look at what investors are doing, because mainly what we're investing in are, liquid securities that are stock market-like securities. So when we go in there and buy those things or sell those things, we have to monitor what investors are doing. And right now, in the short run, you're not seeing quite the enthusiasm that you saw, let's call it back in early March, that we're seeing here in, early April. But it doesn't mean it can't go higher, but what it says is we're very susceptible to a pullback. Now, in the bigger picture, again, we're still seeing, the number of stocks making highs versus lows going up. We're still seeing the number of stocks that are just going up in general versus the ones going down. We're still seeing decent demand overall. So a correction would still be a buying opportunity at this point until proven otherwise. So, but again, if you're going to go in there right now and you've been sitting this whole thing out and you're going to say, hey, I'm going to go buy stocks at the S&P at 1,600 and the Dow at 15,000, you're likely to lose money maybe in the short run. But keep your powder dry. But if the market does keep pushing higher, maybe you start averaging in over time. That's been the best way to approach this market, because we haven't had these huge sell-offs. These little sell-offs we've had that have lasted 3 or 4 days, those have been your opportunities. Right in here, it only lasted a couple of days. That was your opportunity. And it may continue to work that way. But the news is murky. We've got threats of missiles, nuclear missiles being launched. We've got commodities falling out of bed, which some people believe that means there's the global economy's falling apart. But again, let's take a look and see. You look at something like emerging markets, which have really been lagging. They had a little bit of life this week. Had a bad day on Friday, but they've been lagging quite a bit. But let's see if there's a rotation out of America, maybe to emerging markets, because emerging markets over the long run are still going to be growing much faster than the U.S. But right now you're seeing that safety trade. We know we get with the U.S. and the dollar's been supportive. That's why you've been seeing the money rotate into the U.S. So again, we're going to have to monitor this on a day-by-day basis, but I'm not seeing any long-term worry things that make me go, we need to get out right now. But I do think in the short run, we're still susceptible to a correction, which we always are. Frankly, we always are. It's just how are you positioned for that. So, as the market goes up, don't change your overall allocation to get more aggressive. The idea is the stuff that should have been in stocks should be mostly in stocks. The stuff that isn't in stocks that you're buying for income purposes or hedging or principal protection, keep that stuff the where it is. And again, keep this kind of balanced agnostic approach to the market. Don't be suckered into being the ultimate bear or the ultimate bull. There's many pundits on TV, very famous people that say very expensive newsletters that basically got out of the market way back, in early March, right in here when it was rolling over and saying, I'm getting out. This thing this is done. And here we are, well over 100 points higher on the S&P. So don't be that guy that is the all or none. I've known plenty of people over my career that are the all or none, right? And they're the people that own their whole portfolio full of gold, and they had a really bad weekend. Or they're the people that are short the S&P, and they had a really bad weekend. And eventually, it's going to be the person that is all in mutual funds or the S&P 500 on the long side. And while they're bragging right now at cocktail parties, they're going to be the ones that have a really bad weekend at some point. And so don't be that guy. Be the balanced approach, trying to get yourself to retirement, in a methodical manner. And, not that you want to be the turtle, so to speak, but you don't always have to be the rabbit. All right, guys, have a great Sunday, and we'll talk to you next week. And don't forget, Twitter. We're always on Twitter, twitter.com/Karl Eggers. We're on Stock Twits on there. We're on Facebook. We're on Google+. We're on iTunes if you want to use iTunes for the podcast. And then there's eggerscapital.com where we've got reports and we've got, everything on there. And it's the money management website as well. So take a look at eggerscapital.com and have a wonderful rest of the weekend.